Hi, welcome back to the Seller Finance Center. Today we're going to talk about understanding some of the key closing documents that are so critical in a seller finance sale. We'll look at these key documents and how they work together, and then we'll drill down specifically and go really deep on all three: the deed, the promissory note, and depending on your state, you'll also utilize either a deed of trust or a mortgage. Let's talk about how these key documents work and then how they work together. And I'm going to talk about this very specifically from the context or the perspective of after a seller finance sale has been closed. Okay? So there's three key entities in this picture. There is the person buying the home seller financed, who, once the sale is complete, will become the borrower. There's the person who's selling the property with seller financing, so the one offering the financing. And after the sale, they'll be considered the lender. And then, of course, there's the property that's changing hands from the seller to the buyer. So let's start with the deed. So the deed is probably, of these three documents, the one you're most familiar with. It's the written document that shows who owns a particular property. So if you're on the deed, you own the property. So after a seller finance sale, the buyer or borrower will be the person whose name is on the deed, and it says they own the physical house. The second document is the promissory note. This is a written document or a written promise to repay a specific sum of money plus interest at some specific rate and length of time to fulfill the promise. So it's really the promise to pay off the loan that the seller has made to the buyer. And the buyer, in the role of the borrower, right? The borrower is making a promise to pay off the lender. Now, the third document, which is one, you may have heard of the term mortgage, but the way the deed of trust and mortgage work is maybe the least clear of these three. Both documents do the same basic thing. They place a lien on the property, and a lien means that they're using the property as collateral that gives specific rights to the lender to sell that property if the loan is not paid off. So if the borrower does not meet their promise to pay off the loan, then the lender can execute the terms of the deed of trust or the mortgage to sell that house to pay off the balance of the loan. Okay? So there are many documents in a closing, in a real estate transaction, I will tell you that. There are many documents, but these are really the three critical documents that hold a real estate sale together and protect the buyer, borrower, as well as the seller, lender. So let's go a little deeper on the deed. The deed is a physically written document that captures who owns a particular property. To execute a home sale, the seller will actually sign over a deed in order to transfer the property's ownership rights. So they will literally have a piece of paper that they sign that says, I am signing over rights to this property to somebody else. It's a really critical legal tool. And many ownership disputes are settled simply by seeing whose name is on the physical deed. When the deed gets signed, it would actually get filed in the county courthouse or tax assessor or someplace, so it will be on public record. And so the deed, again, is probably the most critical document because it says who owns that home. So they are actual legal documents that transfer the title from one person to the other. We're going to talk about what title means in a moment. It's always a written document. It must be recorded to make them fully binding. Now, if for some reason you forget to file the deed, that does not mean whoever's new name is on the deed doesn't own the house. It means that the deed is what's called in legal terms, it's not perfected. It means there's flaws in the deed because it was never filed. Again, that does not mean that there's a problem with title or ownership of the house. It's just a problem in the way that the paperwork was handled. And it's resolvable, but it just means that you have to do a bunch of extra work to basically prove that even though the deed wasn't filed, that everything was done correctly. and that is achievable, but like I said, it's extra work and it may cost you some money. And so that's why we always recommend you close a seller finance real estate transaction with a title company and or real estate lawyer, because they'll make sure the deed is done correctly and the deed is filed. And so when you're ready to sell the house down the road, you don't have any issues. Now, this is sort of an advanced topic, but there are different kinds of deeds. The one I always recommend that everybody works with is what's called a general warranty deed. It acts as a guarantee to the buyer that the seller indeed has the right to sell the property, and the property is free of debt and other liens. And it also means the seller has to help defend the title again is ownership, against any other claims and compensate the buyer for any unsettled debts or problems that occur down the road. Now, what usually happens is what comes along with a deed is the seller will buy title insurance to protect the buyer. So that's the way they defend title against claims. The real way a seller defends title against claims is by buying the buyer title insurance, and then there's basically an insurance company out there that will defend title on the buyer's behalf. But you always want a general warranty deed because it covers the home for basically anything that came before it that could create an issue around the title. A special warranty deed is a little bit different. It's the same basic idea in that the seller is guaranteeing to defend the deed and the title, but they're only guaranteeing the title for the period in which the seller owned the property and not before. So it's not quite as strong a protection from issues that may have happened before the person you're buying it from, something pops up that wasn't known. And so you do need to be a little bit careful if somebody's proposing a special warranty deed, and certainly consult with a real estate lawyer if you've got any concerns. The last kind of type of deed, a quit-claim deed, you're not likely to run into this. It's really not one you want to use when you're buying a house from somebody else. It's most often used by family members or divorcing spouses or friends that maybe went in on a project together, and one person wants to sign over their rights and their title and their ownership to another party. A divorce is a great example. Maybe it says that the wife gets the house, so the husband may sign a quit-claim deed over to the spouse that says, I'm deeding the house to you. I don't have any title or ownership of it going forward. And then that can be used when the spouse sells the house to help ensure that they can basically use a general warranty deed when you sell it to the next person. Okay? Really, what I really want to see for all of you is that you're using a general warranty deed whenever possible. Now, regarding the deed versus title, property deeds and the concept of title are very similar concepts, but they are, at the end of the day, two separate ideas. When you own a property entirely, you will actually possess both the deed and the title, but they're still different. The deed, as I mentioned earlier, it's a physical document that provides proof of property ownership. And as I mentioned, it normally needs to be filed and notarized. Sometimes you need a witness. Title is not a physical document. It's a concept. Title refers to the legal right to use or access a property and or transfer your interest to another party. You can either have a full or partial interest in a property, but you can never transfer more than you actually have. There is not a physical title document. So title means ownership. The deed is a physical document that proves ownership. Okay? So don't look for a title document in your closing package because you won't find one. That's really going to be the deed. But if somebody says, transfer of title, then that is a concept around, who legally owns the property, and you can prove it with the deed, but title is not a physical document. Okay, so let's get into the next critical document called the promissory note. A promissory note is basically just a promise to pay. Simplistically, you could also just call it an IOU. It contains a maker, the payer, so that's basically the borrower. So the maker makes the promissory note, the promise to pay the lender, also called the payee. An unsecured promissory note, as you might guess, is not physically attached to anything. It's a promise to pay, but there's no collateral. That loan is usually made just on the maker or the borrower's ability to repay. So do they have good credit? Do they have good income? A secured promissory note may also be made based on the maker's ability to repay, but it's also secured by a thing of value, such as a car or a house. Of course, in our scenario, we're talking about a house as collateral. The promissory note, a copy goes to you, the buyer or seller, and the other party, but it's generally not recorded. Okay? What's in the promissory note? You'll have a payer, the borrower. You'll have a payee, the lender. The promissory note will capture the total amount borrowed by the payer. It'll capture the interest rate and what kind of interest it is. It'll cover any terms, length of time, balloon payments, variable rates, any of those kinds of things. It'll cover what's your first payment date, when are your subsequent payment dates due, when does the promissory note end, terms for prepayments, for penalties, late fees, anything that really is outlining the rules of the loan, the terms of the loan will be captured in the promissory note. Normally, the lender will retain the promissory note. The borrower would get a copy until the loan is paid off, and once it's paid off, then they'll sign it off as paid in full, and the borrower would get that document. Okay, so this is really the summary of the loan and all of those terms. Now, along with the promissory note is this idea of an amortization table. So amortization table is not a legal document. It's just all of the detailed summary, the next level of summary of the promissory note. It's a pretty useful document. In this example I'm using, the mortgage that was captured in the promissory note was a 30-year fixed mortgage, a $300,000 principal balance, and 5.25% interest. It then captures the monthly payment for principal and interest, how much you'll pay over 360 payments, that's 30 years. So if you multiply that 1657 times all of the payments you'll make, you get to almost $600,000. 296,000 of that is the interest, right? The rest is the $300,000 principal. And when's your last payment? The chart on the over here says the yellow bars are interest, the green bars are principal. So the total is the 1657. So what you can see, the early payments are mostly interest. The late payments at the end of the loan term are mostly principal. And the red line shows the principal pay down. So you can see early on, the first 5 to 10 years, you're not really paying off that much principal. But as you kind of get halfway through, you can see the principal pay down really starts to accelerate. This table, and I've just got a few years, a true amortization table would actually show 30 years of payments. But in this case, I just took some snapshots of the early payments and then the late payments. And what you can see, in the early payments, it's mostly interest, a little bit of principal, and then the balance kind of gets paid down slowly. And at the end of the loan, you can see the interest payments, are small, and you're paying off mostly principal, and then you're paying off the balance, relatively quickly until you reach zero. Okay? So the amortization table is not a legal document. It's kind of a ancillary document or additional document that goes with the promissory note. As long as I'm explaining documents, I figured I'd spend a few minutes here on how an amortization table works. So lastly, let's talk about the deed of trust or mortgage. These are two different documents. They largely serve the same purpose. They capture the security of the debt, which is typically the property. It basically makes the property collateral for the loan that's documented by the promissory note. So it's basically securing that promissory note with a security or a collateral item, which again is the property. The deed of trust or mortgage is filed with the local county clerk or tax authority, again, depending on where you're located. Some states use a mortgage, others allow a deed of trust. If you go look at this in our blog section of sellerfinancecenter.com, I'll have the direct link to the website where you can check your state to see, are you in a state that uses a mortgage or are you in a state that uses a deed of trust? I will say, and you'll see why, deed of trust in my mind are better documents. And I always recommend, if your state allows a deed of trust, that you use a deed of trust instead of a mortgage. Okay, so let's talk about how the mortgage is different from a deed of trust. Both documents secure repayment of a loan by placing a lien on a property. And as I mentioned, lien gives the lender the right to sell that property to pay off the loan if the borrower defaults. So again, it makes the property collateral for the loan documented in the promissory note. So what's different? So the big two differences are the mortgage has only two parties, a borrower and a lender. The deed of trust, and you may also hear it referred to as a trust deed, has three parties, the borrower, the lender, and a third party called the trustee. The trustee is really the person who holds what I'm calling conditional title until the loan is repaid. So with a mortgage, when the borrower can't pay and the lender needs to foreclose, that foreclosure process and the selling of the property must ultimately go through the courts. This is called a judicial foreclosure. Now, if you use a deed of trust, if the borrower can't pay and you need to foreclose, the courts can be bypassed and you can follow what's known as a non-judicial foreclosure. And that non-judicial foreclosure would be initiated by the trustee. The trustee can be a lawyer at the title company, a lawyer at the bank. There's some different places where you can find the trustee. And again, it just depends on your state. The fact that you can use a judicial foreclosure is the fact that you can use a judicial foreclosure is a much easier, faster, smoother process. It's certainly a big advantage if you're the seller. If you're the buyer, you may want it to be much, much harder to be foreclosed on. So you may prefer a mortgage. If you're taking my class or you're looking at this, I would never say go into an engagement like this, a transaction like this, with a plan to be foreclosed on. That's really not the right way to kind of go about it from a mindset perspective. So I always recommend a deed of trust, get that third party involved to go help bridge the gap if there are issues. And certainly if you are the seller, it's going to make it easier for you to foreclose if you can use a deed of trust. So the deed of trust or mortgage in a bit more detail. Both documents include the trustor or the borrower. Both documents will include the beneficiary, also called the lender. And then the deed of trust will also have this third party called the trustee. Both documents will include all the following elements: the loan amount, the legal description of the property, who are the parties, some basics about the loan, and a lot of the same things you'll see in the promissory note. And again, one of the other big differences between this and a promissory note is these documents do get filed and they are on record with the county clerk or, again, whatever is a legal entity in your area that maintains the real estate files. Key takeaways: there are many, many documents in a seller financing closing. However, the deed, the promissory note, and then the deed of trust or mortgage are definitely the big three. Each document plays a very specific role in summarizing the legal agreements in a real estate sale. They are critically important in protecting both the buyer, who will become the borrower once the sale is complete, and protecting the seller, who will become the lender once the sale is complete. It's important that as you go into a seller finance transaction, or any real estate transaction for that matter, that you understand the role of these three documents. And it's also critically important that you engage with a title company or real estate lawyer to ensure that these documents prepared correctly and filed correctly so both parties will be protected. So thank you again for joining us at the Seller Finance Center. I hope this summary was useful, and we hope to see you back at the Seller Finance Center soon.